co-CEO of the Real Wealth Network, host of the Real Wealth Podcast, and some other thing. She does so much. I don't remember what it is, but Kathy Fettke, welcome.
Hey. Oh, how are you holding up? The brains have got to be a little overfull, so I'm going to do my best to fill them up even more. All right, we're going to do my best predictions for 2017, and that is not easy. But there's a reason why I care and why I want to constantly be studying the markets and understanding them, because did anybody get a little blindsided in 2008? Anybody? Just me? Just 4 people? The rest of you were amazing. All right. Well, Rich and I got married 20 years ago. This is my other co-CEO right there. And we got married 20 years ago, and this was our first house. And we got very, very lucky with this house because we got it no money down. It was it was a problem for my dad. He had a 1031 exchange. He needed to find another replacement property. He didn't want to be a landlord. So Rich and I said, well, your biggest problem is you need to find a house and someone to live in it. I think we can do that, because we were living in the spider house at that time. That was our first home, and it did have a lot of spiders. You could get rid of them and they'd be back the next day. So we found this house, and we got it for $546,000 in '97. Totally by accident, no idea about market cycles, but '97 was the bottom of the last downturn, so it was just up from there, 10 years of up. And so this house went from $546,000 to $1.8 million by 2007. In 10 years. And we just thought we were really good at this or something. And then it was, 2 years later, it was back down to 800,000. Now, we didn't sell because we were attached to this house. And we didn't sell, I should say, at 1.8. We sold at 800,000. So that was $1 million loss. So if that gives you any indication as to why I care a lot about market cycles, that's just one of the losses. I also bought 2 houses, forced Rich to sign the documents. I'm like, Boise, Idaho, this market's hot. Yeah, now I know also parts of the market cycle are to make sure you're in an area that has enough population, that you have enough renters, and also has more than 2 employers. That's a lesson learned. So that's why I care about market cycles and I'm obsessed with it, actually. And this is why I don't listen to anybody else. I just try to do the research myself and share it with you and let you decide what you think of the data that I've shared. But this is one of the reasons I don't listen to the Fed. I don't really care what they say in Congress. Janet Yellen was just in there saying whatever she said. It doesn't matter, because this is what Bernanke said in 2006, the slowing in activity will be moderate, then house prices will probably continue to rise. In 2006, this is the chairman of the Fed. Now, what's the Federal Reserve supposed to do? What's their job? To stabilize the economy, right? So they should know. All right, so then in 2007, maybe there were more clues. So I'll give him a break. Maybe there were more clues by 2007. He said, despite the ongoing adjustments in the housing sector, overall economic prospects for households remain good. 2007. 2008, at this point, I'm sorry, there's no excuse for not knowing what's coming. The Federal Reserve is not currently forecasting a recession. And for those of us who, if you were there at that time, you know what happened in September of 2008. That is when Lehman Brothers came crashing down. So how could he not have known? That's terrifying to think that the Fed couldn't know something so obvious. It's either they didn't know or they didn't want us to know. And that's terrifying too. Either way you look at it. And at the time, I was a mortgage broker, and I was fairly new to that business. I think I started in 2004. And 2005, I remember coming home to my husband and saying, honey, I did this loan, and I turned it in, and the bank said, this person didn't make enough money, so we changed it, and now they do. And I'm like, oh, I came home, I'm like, does that seem right? And he's like, that sounds like fraud. No, that does not sound right. I'm like, but everybody's doing it. That doesn't make it right. So there were so many loans I had to turn down because I live with Mr. Integrity. He's like, don't do it because it will come, it's not right. And so seeing at that time, and then it got worse, 2006, 2007, I could have, if I did not have integrity, I could have given anyone a loan, and people did this. Homeless people, I could give you a loan, a $5 million loan on a Nina loan, no income, no assets, and I could give you that loan. And you know what I could make on that loan? 3%. 3%. It was so easy to be greedy. And so I knew something was wrong. How could Goldman Sachs not know that's not going to work in the end? I remember a woman coming to me saying, I want this loan, I want to buy this $500,000 house. I'm like, well, you make $2,500 a month. I don't know how you're going to do that. But the teaser rate would allow it because she could get qualified by the teaser rate. So I'd say, well, when this adjusts, it's more than you make. You're not going to be able to make the payment. Oh, that's okay, I'll just refi then. And I'll take cash out and do what my neighbors are doing. So, again, there was somebody sitting in a boardroom saying this is okay, but there'll be no consequence, right? So who was that? So anyway, this is why I don't listen to economists, even though I have a ton of them on the show, but I just like to hear what they have to say. And why I don't listen to journalists. I was one, and I can tell you when I worked at Fox News, I would get a health care bill, that was this big, and the station would give me 45 minutes to read it and write on it and report it to you. And so it was pretty tough to get that right. So I already knew that journalists have a tough job. But then, back in 2005, again, Time magazine comes out with, Home Sweet Home, why we're in love with real estate, and why you can make money, and gives all these stories about how people are making money. And then they were. And then in 2006, David Lee Ray comes out with this book, Are You Missing the Real Estate Boom? Why Home Values and Other Real Estate Investments Will Climb Through the End of the Decade and How You Can Profit. David Lee Ray was the chief economist for the National Association of Realtors. The National Association of Realtors, chief economist. Whenever I tell this, I think, I've definitely made some mistakes. I've made some predictions that weren't totally on, but I did not write this book. And that makes me feel really good about myself. Can you imagine? Okay, chief economist is just like, I don't know where he works now. Anyway, so then in 2010, Time magazine, again, gets it all wrong, all backwards. Rethinking homeownership. Why owning a home may no longer make economic sense. Right? 2010, terrible time to buy a home. Anybody buy a home in 2010? Was that a bad idea? No. Okay. Well, that's why on the Real Wealth Show, I just decided this is going to be a place where I can figure out what the heck is going on. And I only want people on the show who have had, ideally, 30, 40 years experience to be able to say, oh, yeah, we did that. History repeats itself. Oh, this is what's going to happen. So I would interview people like Robert Kiyosaki and Dennis Kaminsky and people who have been around and doing this for a while because I wanted to learn, and that gave my listeners an opportunity to learn. But honestly, it was selfish reasons. I just wanted to understand because none of it made sense. And so the one thing I want to leave you with, because I'm condensing what I can honestly talk about for days, I'm condensing down to the core of my message, which is nobody knows what's going on. That's the bottom line. Nobody knows. And so you've got to trust your gut. And too often, as new investors or investors in general, we'll give somebody else our power and think they know more. And that's how new investors lose money almost every time, because they think that person knows more, even when it doesn't feel right. And Rich was a perfect example of not doing that when we almost bought a couple of condos in Vegas in 2006. And he's just like, it just doesn't feel right. It just doesn't feel right. And I'm like, fine, okay, that's a weird thing, but let's just go with it. And he was right, obviously quite right. So, you've got to be able to trust your gut and also listen to common sense. And so common sense at the time, this is directly what Kiyosaki told me in 2006, 'cause I'm like, what's going on? This doesn't make sense. And he said, well, I'll tell you what we're doing. We're selling everything in California and we're buying in Texas. And this slide kind of can show you why. That blue line was the house price growth in the US, and the red line is Texas. So where it peaks was right where I was asking questions. But I was in California, so actually the line goes up to where the title is. I mean, it went all the way to the top of that page because California home prices were so crazy. Nothing made sense. And as a lender, I knew that. Because if actually anybody had to make their real payment, they never could. There's no way. And so, to be able to look at this way overpriced market of California and the US in general, but Texas, it was like flatlined. Like, look at that, nothing happening there. And so but that wasn't true. Something actually was really happening in Texas. It had the highest job growth and population growth in the entire country, and yet housing just hadn't caught up. It was still 28% undervalued. So it was at that time I learned that the US doesn't just, markets don't operate in the same market cycle. So, people will always ask me, where are we in the market cycle? It's like, it just depends. It depends on where you live and your market. Because here, California was whack, and Texas was at the best buying opportunity possible. So you had this chance to sell at the peak and exchange that property at the trough, at the beginning of a boom in this other market. And you can see from that graph, as the rest of the country crashed and California came even more crashing down, Texas just held flat, held steady, and then started to grow. So that's when, I kind of put it together, and I was doing these loans in Stockton, $450,000 for just a pit, a money pit, just repairs needed, and it would get $1,200 rent. The numbers didn't make sense, and I just couldn't understand why someone would come to me and want this loan. And when I knew by now that same person could buy a $150,000 brand new house in Texas, buy all this job growth for the same rent. And so I would say, well, hey, there's an option. Do you like this option? And I realized there was, yes. The answer was yes, I like that option. I just don't know how to do it. So Rich and I actually flew out to Texas, refied that White House, bought, I don't know, a bunch of properties, 14 or something, in this part of Texas that was, it was called Rockwall. Anybody know Rockwall, Texas? So we were buying houses brand new there for $130,000 to $150,000. And we knew there was going to be a pop because a new freeway was coming in. That was one of the metrics I was learning from these experts on my show was find markets where something's happening. And in those markets, find out what's happening even more. And so what was happening was all this job and population growth. And so the city had to adjust. And so we knew there was a new freeway coming in to connect Dallas to Rockwall. And it would make the commute very short versus having to go around this lake that would take an hour. And the difference between a 20-minute commute and an hour commute means money. It means you're going to probably get more money. And these houses now are worth 2-3 times what we paid and other people paid. So we started to see, wow, this is a need. We need to help them get out of California and get into markets that make sense. And that became our business model. So over time, we got a reputation. I think Rich put a video of testimonials on our website and a video of me saying, yeah, we just helped this lady sell these 3 Stockton properties for $450,000. That's like $1 million, and we were able to get her 9 properties in Texas for the same money and exchange it, and yet she tripled or quadrupled her income. And then the person who bought that house, a couple years later, the people she sold those Stockton houses, actually they ended up with an asset worth $75,000, down from $400,000. So these were the kind of testimonials on our website. So one day, Rich and I were in Phoenix at the Infusionsoft conference, and I was just kind of sitting there listening, and I get this text. It's like, Robert Schiller would like to debate you on Fox News. Okay, why? Well, he won't debate anyone. He will not, he's refused every time, but we want him to this time. We suggested you because you have a San Francisco State education, let's face it. He's like, they didn't say that. They're like, here's this Yale, Nobel Prize winner. He didn't know who I was, so he's like, sure, I'll debate her, fine. So I put on my daughter's sweater. I was dressed in sweats, I'm like, oh my gosh, what am I gonna talk about? So I put on my daughter's sweater. Thank goodness they had, these amazing makeup artists at Fox News. It's amazing. I mean, it's like plaster that they put on your face. It's awesome. So they did all that, and I get on the set, and Rich has coached me on how to breathe and get through this moment. And then as soon as he started talking, all fear was gone. So I really actually didn't know if I was going to survive this interview. But all fear was gone when he said, yeah, it's just a really dangerous time to buy. This was 2012. I'm like, why? Home prices are at all-time lows, interest rates are at all-time lows. People can just lock in a fixed payment for 3 decades while rents are going up. And in the end of 30 years, they own a home outright that's going to be worth more than it is today in 30 years, most likely, based on history. What does the renter have? Increased rents every year and nothing in 30 years. So I'm like, I don't understand. I think you're misleading people. And he was like, yeah, that's probably right. It's probably a good time to buy. And so I'm going to say that I won that debate. Yeah. And that, thank you. So you get this Yale economist who, the creator of the Case-Shiller Index, and me, just kind of again, San Francisco State education, but it was common sense. It just keeps coming back to that common sense. What are you talking about? It doesn't make sense. And so that led to this, to where after that interview, I'm a pretty regular on national TV because there are I think it's because they get that we have a network of 28,000 people telling us what's really going on out there and not just an economist sitting in his office looking at data. And so we have become a resource now for the news. So here's the part of my talk where I am most definitely, without a doubt, going to offend at least half of you. All right? So let's just get that out in advance. And half of you will agree with me and half of you won't. And most people don't even want to talk about this subject because it's scary. But it has become very difficult for anyone to predict. It used to be a little bit easier for me to just look at the data and say, all right, here's where we're headed. But we just don't know which guy we're going to get. We're going to get either the very presidential Trump or we're going to get that guy. And, it just changes on a day-to-day basis. But the bottom line is we don't know. It's very much a time of uncertainty. And so I'll go over some of the things that are more certain than not, because in a time of uncertainty, it can be a scary time to invest. And so if we can make some sense out of it all and try to come back to that place of common sense, then we can just sift through the noise. Because there's a lot of noise out there about this, isn't there? All you have to do is turn on the TV and it's just like, so many different opinions. And so what do we know? Let's just start with there. Well, we know that there has been a massive Trump rally, which means there's a lot of optimism out there. A lot of people think that what Trump is going to be able to bring to America will be good for the economy. And so, look at that, 20,000, we break 20,000 in the Trump bump, in the Dow. Generally, when investors are feeling optimistic, they get out of bonds and they get into the stock market, and that's played well for them because people have made a bunch of money since Trump was elected, but bonds have tanked. And usually when that happens, then that affects mortgage rates. And so when bonds tank, mortgage rates, which are tied to the 10-year, start to increase. So that's why we've seen this increase and a lot of fear around, are these interest rate increases going to affect real estate, and how will that affect us and our portfolios? So I'll be addressing that. And then, is inflation expected to rise? A lot of people think so. The Fed seems to say it will. And if that's the case, it could affect decisions we make with real estate. One thing we know for sure, that in an inflationary economy, it tends to be really good for hard assets. So, meaning that asset prices usually go up, and if you own the asset, that's good. If you don't own it yet, not so good. The Fed raises rates when there is a booming economy, and that is the way that the Fed tries to balance it all out. That if things are getting too hot, they raise rates, tighten the money supply, and that slows things down a little. When we're in a recession, lower rates, that it makes money cheaper and gets money out there, increases the money supply, and helps move us out of a recession. So the Fed has said we're going to raise, well, they raised rates in December and say they're going to do it 3 more times. That would indicate, obviously, to these Dow Jones investors that positive things are ahead for the U.S., for the economy. If indeed the Fed were to raise rates, that would mean that the economy is booming. And then, of course, the job outlook is looking positive for a lot of people. The last jobs report looked pretty good. If you don't look too close to it, you're close at it. So why? What is happening that is making investors feel so confident? Clearly, less regulation. The belief is that if there's less regulation, then businesses will be able to thrive more. And certainly that could affect us as real estate investors if he succeeds in revamping Dodd-Frank. The main reason is that Dodd-Frank has made it really tough for small businesses to comply. There's 2,300 pages. You'd need a whole army of attorneys just to figure out how to be compliant. And so it's been very tough for small banks. And if those regulations are lifted, that could mean more lending, which could be good. Revamping Obamacare. If he succeeds at that, that's more money in people's pockets because we wouldn't be paying that extra tax, potentially. And if he succeeds, that could be tough. Then it could lower, of course, medical costs or insurance. Cutting taxes, that's a stimulus. These are all stimulus-type moves for the economy. Cutting taxes generally means that people will have more money to spend on the economy. Increase military spending. This is a stated goal. That generally creates more jobs and stimulates the economy. Investing in infrastructure. We don't have the money for it, so it will be deficit spending. We'll be borrowing money to do it, but creating jobs that then, the theory is, okay, we're borrowing money to create these jobs, but these people will be paying taxes, and it will stimulate the economy, and it will all be okay. We'll be able to pay for all that extra debt. And then, of course, the big one, bringing jobs back, right? That was the whole campaign, bringing jobs back by taxing imports and getting companies to come back to the U.S. and making it more favorable to do so. Again, this is the Trump bump. This is why everybody's so excited. So let's dig in a little deeper and see how it might affect us. Because a lot of people, you can raise your hand or not, if you agree, a lot of people feel like, smooth sailing. America's going to be great again. Raise your hand if you want to. I don't want anybody fighting afterwards, so don't. But there is, obviously for these investors, there is a belief that it's smooth sailing. And here's more what I'm thinking that we're looking at. And it has nothing to do with Trump. It's, he's going to, if he does what he does, it would be good. But will it be good enough to deal with this? Can anybody, any policy at all, deal with this? So let's look a little closer, because I will tell you now, I think there's actually a formal speech writing or movie thing where you take people down and you bring them back up. There's an emotional thing. I'm actually not trying to do that, but I'm going to tell you I will. We're going to go down for a minute, and then we're going to come back up. I promise. We'll end on a happy note. But we have to talk about this national debt because nobody wants to talk about it. But it's the same, in my opinion, as what happened 10 years ago when nobody was talking about the mortgage debt. And I'm just coming home looking at my husband going, this is weird. I could feel the rumblings and I could see, something's coming. Why can nobody see this? Well, we have the same issue. It's just a different kind of debt. It's just a different kind of debt. But if you paid your mortgage and you were not, you didn't get a liar loan and you had equity in your home, were you affected by the default of someone else? So if you did everything right, you still got nailed by someone else not doing it right. So here we are with kind of a similar but much bigger problem that nobody wants to talk about, but we have to. And the reason we need to talk about it is because you can structure yourself in a way that you can not only survive but thrive in the coming years if you know. Because let me ask you, if in 2006, when again Bernanke didn't see anything wrong, but you kind of could sense something like I could, and I'm sure many of you, would you have done anything differently in your portfolio? Thank you. I would have. Anyone else? Would you have done, what would you have done differently? You would have sold. You would have sold some property. Me too. Me too. The Boise ones for sure. Yeah. You know what else we did? Again, he's still married to me, 20 years, man. It's amazing. But I also kind of forced him to buy these 2 construction properties, brand new construction. And instead of getting a construction to perm loan, I was in the business, I knew to do that, we just got a construction loan. Well, you know what? Those balloon. So by the time that the homes were completed and the balloon note was there and we had to refi into a regular loan, guess what year it was? Guess how many properties we had? We were over the loan limit. No one was going to give us a loan. So here we were stuck with these Tennessee brand new properties, and we had to come up with like $400,000 cash that week, or Rich was going to go to jail. That's how they do it in Tennessee. You don't pay your debt, you go to jail. It was nuts. So yeah, I would have done a lot of things differently. So let's talk about the debt. So I think you've all heard about this, but Bush doubled our debt, our national debt, from $5 to $10 trillion. Then Obama came in and did that again and went from $10 to $20 trillion. So we are now $20 trillion in debt. So what we know about what I just said about Trump's plans are that he's suggesting cutting taxes, right? So that's less revenue. And that, I mean, a lot of people, again, will say, yes, cutting taxes, but it's going to stimulate the economy. But when you just look at the numbers, that's less money that the government's collecting. And yet, more deficit spending to the tune of, 500 million? Billion? A lot. It's a lot. Billion? It's a lot. So the plan is just to get in more debt. So I don't think anyone is saying that Trump is going to lower the debt. It's increasing. And so what does that mean? What does that, do we have to pay it? Can we just ignore it? We've been ignoring it for a while, so maybe we'll just do that. I don't know. These are the I don't knows. What do you do with this much debt? And where did it go? And so, here, I'm gonna go back a slide because I wanna go over this first. When Rich and I had that, let me put it this way. There's good debt and there's bad debt, right? So some of this consumer debt, the line below is consumer debt, the line above is national debt. So also there's been a lot of consumer debt. But I think a lot of that, I'm hoping a lot of that, I haven't broken it down, I'm sure that a lot of it's credit card, but a lot of it was people buying homes. And so that's good debt to me. I don't have a problem with that kind of debt. You've got an asset. If you bought investment property with debt, better yet. Now you have an asset that you're leveraging and your cash flow is paying that down and your tenants are paying it down, so there's good debt and bad debt. But when you have good debt, you usually have something, an asset, right? A good asset. And so what did we get? We spent $20 trillion. What did we get? Where are our assets? What are they? What did we get? $20 trillion. Like, that's our money. Anyone? Okay, well, let's look at it. 68% went to pay the debt and to pay entitlements. And those entitlements include Social Security, unemployment, labor, Medicare, and then the interest on the debt is the gray. There's the military there is the yellow. And then you can see the little slivers of things that, education is, and then, science is So like, there's not much money left over. Now so then you just go, okay, well, what else do we get? We have, if you really look into the military, even though there seems to be a lot of spending there comparatively, a lot of people in the military are saying it's actually very weak. And that is why Trump wants to fix it. My nephew is a pilot, and from what I've heard, 3 out of 6 planes can actually fly. So I don't know anyone here in the military that can verify that it's not, we're not what we used to be? No?
This way over there.
There.
Well, we've been at war for like 16 years now.
Yeah.
It's expensive in treasury and lives, so.
It's expensive.
Yeah.
It's expensive, and there's not a lot of money. Yeah, and so infrastructure's crumbling. I just did a show on Real Estate News about just our water system, and that, so again, Trump's talked about this, but his stated goal is to get us to a 3% GDP, and I actually think with his plans, he could do it. He could do it, and it would be a big deal because it would be a 50% increase from where we are now. So if he succeeds, he has done an incredible thing. But unfortunately, it's not enough. It's 3% GDP is what we need just to pay our interest on our debt, let alone all these other things. And so also with the Medicare, I gotta hurry through this. We have an aging population, so that the entitlements is only gonna increase because there's 10,000 people turning 65 every day for the next 10 years. So that whole section on entitlements, it's believed that once you include that, it's more like a $200 trillion debt. So it's a massive debt that probably can't be repaid. And so there will have to be some ramifications for that. And Trump himself has said, we'll renegotiate it. What does that mean? When you renegotiate debt, you're not paying it, right? I just renegotiated some debt, and it was awesome. I got $1 million down off the debt. It's great on a loan on an apartment, but it's a little different when that, who's on the receiving end, who's not getting paid. So that's what hasn't been made clear yet. Is that a lot of these are going to be pensions. So now when the Fed says that they're going to raise rates, but they haven't. They said they were going to raise rates 4 times last year, and they only did it once. And then now they're saying we're going to do it 3 more times this year, and 2 months, two meetings have gone by, January, February, and they didn't do it. So if, the jobs report was decent, we hit our inflation goals, normally they would raise rates, but they didn't. And so instead, they are flatlined. The rates that we have right now, the Fed fund rate, is still at 0.5% or 0.75%. That is recessionary. That's where you take rates when you are trying to resurrect an economy. So if it's so hard for the Fed to raise it by 0.25%, they only did it 0.25% last year, even though they said they'd do it 4 times. They're lying to you. That's all I can say. The things are not as they say. Otherwise, they would raise rates. So again, just know that a lot of information you're getting is not accurate, or it's cover-up sometimes. So these are the wild cards. Interest rates going up or down. A lot of people think they're going to be going up. I think they're going to be going down as we start to see some of this come forth, that there's issues. We have issues, and if that rears its ugly head, it will have to. The only way to kind of get through it without anyone noticing is another dump of money into the system, another QE. You only do that when you're in trouble. And so that's when that happens, we would most likely see interest rates go back down or stay. So I don't actually think we're going to see interest rates go up. That's just my opinion. Inflation versus deflation. I don't have enough time to go with that. I actually have this whole presentation on our website that you can download at realwealthnetwork.com under webinars. It's free. I also have it on the Real Wealth Show. I just posted that. So if you want to see the full thing, I can go into this a little bit later. But There's all this talk about interest rates and, wow, is this going to affect real estate? And if you look at the chart here, interest rates are still at 4.25. They're still so low, historically speaking, that it's really not an issue. And I don't see it being an issue really for some time. So that's not an argument I'm worried about at all. The only thing, if I'm wrong, then which markets would it affect if interest rates did go up? Yeah, for sure. Well, in this one I'm talking mortgage rates, but definitely the Fed fund rate. If that's increased, that would pierce the bubble in the market, and that's why they don't want to do it. It's one of the reasons. But interest rates, for mortgage rates, if they did go up, and I'm wrong, it would affect the already unaffordable markets. That's where it would affect. It wouldn't affect the affordable ones. And so if you want to play a defensive strategy, just be careful about being in markets that have already reached their affordability cap, and many of them have. So these are just some slides on existing home sales. That slide kind of shows that we're not anywhere near the peak. So there's kind of moderate on home sales, yet we're back past peak pricing. So not as many sales, but the sales that are happening are above 2006 levels in general. Not everywhere. These are housing starts. Look at that. Look at this one. Housing starts just fell off a cliff. Talk about market timing. If you can learn to time markets and see what's coming, you could buy land right there at the trough when they were giving it away. And we did. At Real Wealth Network, we ended up being so lucky connecting with developers who sadly lost everything, but were still really good developers. They just got hammered by this. And we had an opportunity as a network to be the money for them. So we were buying land at 10 cents on the dollar back then. It was unbelievable, the kinds of deals we got because of that market timing and understanding it and being ready for it. These are just some of the syndications that we did. We just opened up our crowdfunding site. It's Real Wealth Crowd, if you want to check that out, realwealthcrowd.com. But these are just some of the things. We got this waterfront property in Portland for $3 million, 27 waterfront townhomes because the bank failed. And I mean, there's so many opportunities, which may be opportunities coming up because we have $90 billion in commercial loans resetting this year. 45 billion, half of them are underwater. These are balloon notes. You're not going to be able to refi. So there is an opportunity coming to do this kind of thing again in commercial. So be careful about paying too much, knowing that this tsunami of debt reset is coming in the commercial world. There could be some fantastic opportunities coming, but you don't want to be the one that paid full price, giving someone else that opportunity. Home ownership at 50-year lows. I'm going to kind of go through this a little bit faster. We know that home ownership is at a 50-year low, so great opportunity to be in the residential market. There are 43 million rental households out there. And here's an amazing fact. Out of those 43 million households, 85% have less than $10,000 in savings, more like 500 out of 43 million households, and that's like 111 million people. 85% of the people who got loans had FICOs over 700. So even if Dodd-Frank loosens up and we have less regulation, banks are not really keen on lending right now. They're scared. And so I don't want to go through that again. So they are giving a historically high number of loans only to people with good credit. And then you've got the average credit card debt at $16,000. So the bottom line is 3% of today's 43 million households can qualify for a loan. So again, it's sad, and it's also an opportunity for us to help, however we can do that. And so here are some of the demographic shifts that are so important to be aware of. This massive shift that means you cannot expect the future to be anything like the past. Do not make your decisions based on any historical data, I'm telling you, because it is shifting. We have this massive baby boomer population that used to drive the economy. That's 75 million today, but they used to be just driving it. Look at that sad group of people. It's the orange line. It's declining, and there's only one reason for that. Yeah, I'm a baby boomer, so I can say that. And then we've got I got it backwards. The boomers are the 74 million. The millennials now are the larger generation, larger than the boomers. So now we have a complete shift in economics because baby boomers have been driving the economy for 40 years. They fueled the stock market, they fueled the housing industry, and now they're retiring. What do you do when you retire? You downsize. You pull money out of the stock market. You're not putting money in it anymore. You're pulling it out. You're spending less. You are not contributing to an economy that is based on spending money. 80% of our economy is based on consumer spending, and this huge population is pulling back. So that will affect the stock market. The stock market's on a tear, but did you know that almost the full majority of it was corporate buybacks? Borrowing money at almost nothing and buying their stock back. This wasn't baby boomers saying, hey, we want to invest. They're taking their money out. Will the millennials be able to take their place? Will they be rushing to invest in the stock market? I don't think so. Not yet, at some point. And will they be buying homes? Hopefully, but maybe not yet. Millennials will be driving 2/3 household growth. That's I think I'm over time now. Okay, I will wrap up. They're creating 2/3 household growth, and most of that is expected to be rental. So we have an amazing opportunity to provide housing, and this is just a chart to show that in the past, in the 70s, this first one, it was mostly multifamily that you would rent. If you were a landlord, you had multifamily. This shows that it's really split. A lot of the darker is single-family home demand. And so there is equal demand for multi versus single family. And in a lot of cases, single family has much higher yields than the cap rates you're finding in multi. So definitely something to look at. Last slide, and then I'll stop. This is some of the migration patterns. I show this to my California members because look at red means people are leaving. It's out migration, and look where they're going. These are the kinds of things that we have to pay attention to because what has been is not what will be. It's all changing. All right, so all of this is on my website with best strategies. You can go there, realwealthnetwork.com, and look at the rest of the webinar. And then I've got a bunch of books. I have, I'll just get to that slide. It's okay. It's all on the site. I knew I couldn't do it in 30 minutes. I tried. But I've got it all for you, and I'm here to talk afterwards. I did bring some of my books, Retire Rich with Rentals, where a lot of this information is in there. And like I said, we are actually giving away the ebook on the app, but I also have some actual books, not enough for everybody, but we'll be back there and we'll give out what we can. And then, like I said, if you go to realwealthnetwork.com and join, it's free. You can get the full webinar there. Well, thank you.
Want to take 2 questions?
Oh, 2 questions. All right. Yes.
You mentioned you think interest rates will continue to go down, and I hear Robert Kiyosaki talk about the possibility of negative interest rates.
Yeah.
I wonder if you could just talk about what that looks like and if you think that is actually a possibility.
I do. I mean, I don't think it works, and I don't know if they'll try it here. They're trying it in other places. It's such a strange concept, negative interest rates, but the bottom line is when you have this much debt and most of all of our money is going to pay that, the best and easiest way to pay it is to not have interest, so that if it's negative, maybe that's even better, but it hasn't been proven to work. So it's basically right now, central banks are realizing that it's not working, what they've done, and there will be backlash. It's just how will it look? And how can you protect yourself? Being in the right place at the right time. I mean, if you owned rental properties in affordable markets by jobs that are recession-proof, did you feel the recession in 2009? You didn't. You know what you felt? A raise. Because everybody lost their houses, and so the rents were going up. So even though your asset value may have declined during that time, your income was going up. So there are ways to protect yourself. You just have to know what's coming. And I just don't want people relaxing thinking everything's okay, because there are some rumblings out there of things that could be coming. Yes. Any other questions? One more? Yes.
Who are some thought leaders you like to listen to other than Robert Kiyosaki?
Oh gosh, now my brain, they're all on my show. I interview them at Real Wealth Show. And I do like to listen to him. I interview Harry Dent sometimes, he's way out there, but I think this demographic stuff is good. I love John Burns. He just came out with a demographic book called Harry Dent was the demographic cliff, and then John Burns does real estate consulting, and his book is fantastic on demographics and the shifts there. And it's so important to understand that when you can get ahead of the demographic changes and the migration patterns, then you can truly profit. That's all we want to do, is find out where are people going, where are the jobs, where are cities investing in themselves, where's the infrastructure, who's spending billions of dollars to improve their infrastructure, because that's where I want to buy. And Detroit, that's one of those places. It's coming around. There's billions of dollars being invested in a revitalization of Detroit and Cleveland and some of these affordable markets with job growth. So there's opportunity. Just don't overpay for anything. All right. What was that? One more from the Okay, yeah.
If the answer is we're going to print our way out of this, how's that going to?
Well, that is a great question. So a really easy way out is to just print more money. And that's what we've been doing, and that's why it's kind of that feeling like when you walk into back in 2006, Rich and I walked into the Citibank and they gave me a $250,000 equity line. The guy's like, I'm making a deposit, and he's like, oh, you can have a $250,000 equity line. Okay. You know how fun that is? I have money. So, we feel prosperous when we get loans, right? When we get all this money. And so that's what this party has been. It's just borrowed money. It has to be paid back eventually. So the can could be kicked down the road a little. And so the thing is, you don't know. I'm guessing that's probably what's going to happen. There will probably be another QE, which means that we could just kind of keep what we're doing for a little longer. But you need to know that the music could stop at any time. So don't be invested in my opinion, risky projects that might be long-term, high-end, with lots of rehab that's going to take a couple of years. That, to me, is risky. All right.
All right. Awesome. Thank you.